Hello and welcome. Thank you so much for making the time. My name is Emma Davidson and this is Staude of the Global Value Fund.
Hi there.
Today we're coming to you from our London home office.
Our daughter's bedroom, in fact.
Yes, it's the quietest room in the house. And the reason for that is over the last 4 months, COVID-19 has become a global pandemic, ending the longest bull market on record and bringing with it an unprecedented amount of market volatility and uncertainty. And what we're hoping to do over the next 10, 15 minutes is talk a little bit about what that has meant for the GVF portfolio and what it means over the next 12 to 24 months. And contrary to what feels to me at least like a barrage of negative news flow, we're hoping that this video will be slightly uplifting as we talk about... We're going to try. As we talk about some of the exciting opportunities that we're coming across at GVF. Okay, so let's get cracking. Miles, we've had this severe market downturn.
Crack away.
And then a partial market recovery. It's all happened in a really short period of time.
Yes.
Introducing a huge amount of volatility. What has it meant for GVF and what does it mean for us in the future?
Sure, okay. Well, I'll start off with a quick reminder of our strategy because it probably helps some to understand some of the important points as I get into it. But just as a quick reminder, the core of what we're trying to do is reasonably simple. We sit in London, we invest all around the world, and what we try and find is situations where we can buy dollars worth of assets for only, say, 80 cents. Then we employ a very active, very hands-on strategy that's designed to unlock that underlying value for our investors. And what we're trying to do is provide everyone with two sources of return.
Okay.
You get the returns from those underlying dollars that we've bought cheaply, and then that second source of return, which is our ability to unlock value from these situations. So with that in mind, the really important dynamic to understand at the moment is all this volatility you're talking about to create these big dislocations in the markets, in the parts of the market that we specialize in and we know really well. And as a simple rule of thumb, the dollars we used to hunt around and try and buy for 80 cents, we can currently buy for 60 or 70 cents and sometimes even cheaper than that. We've just actually finished buying a big position for the fund we're really excited about, where we've been buying the company below its cash backing. So we get all the cash and then on top of it all the assets, and we're buying it below cash backing. So at a high level, all the dislocation we're seeing in the markets made our little investment strategy and our investment universe much more exciting than it normally is.
Mm-hmm.
As a rule of thumb, every dollar we're putting to work at the moment, we're putting to work almost with a return target almost twice as high as we normally find.
Wow. I mean, that's really exciting for the future. Can you talk to me a little bit about what that has meant for us, the GVF portfolio right now?
Oh, so for our existing holdings, yes. So when we talked about this in our March and April updates at some length, so I'd encourage anyone to go grab those announcements because we put a lot of time and energy into that. But what we were saying, and the key thing to understand is we know that when we have these big risk-off events in the markets correct heavily, discounts and everything widen for a short period of time, quite substantially, and to levels that are frankly not sustainable over any real length of time.
Okay.
We're well aware that obviously we design our portfolios to be able to cope with situations like that, and our portfolios behave as we would expect it to throughout this period of stress. But much more importantly, we design our portfolios to be able to capitalize on the new opportunities that come along. So we build into the portfolio a lot of natural liquidity. The portfolio turns itself over quite frequently, and that's meant through this period of time we've just been through, we've had a lot of capital coming back to us we could put to work. But for the ones that haven't yet hit the catalyst, we haven't had a chance to release the value, it has meant the discounts have moved wider on those. We do take a short-term mark-to-market loss on some of those holdings. We're quite relaxed with that because what we're mostly concerned about is the see-through value we're going after, the underlying value of these assets that we've bought. We deliberately design the portfolio so that it has on a see-through base, it has a very low risk proposition. It's designed to hold up well through periods of market stress like this.
Mm-hmm.
And what I'm talking about here is the discounted dollars we've gone and bought around the world, the portfolios of bonds, equities, other asset classes. To put some numbers around that, I mean, the calendar year to date, the see-through value of our portfolio has only fallen by about 2%. So in the context of all the big moves and all the noise and all the press, I'm actually quite pleased with that outcome.
Absolutely.
For GVF, it means that the value we're going after, the value we work to unlock, hasn't gone anywhere. It does mean in the short term we've taken a bit of a mark-to-market loss on discounts, which is a separate factor. But given some time, unlocking value, unlocking discounts is actually the one thing we can control in the market, and we've done that for a long period of time now. So we have taken a short-term mark-to-market loss on some of the holdings. It hasn't been too severe, but the key point to, I guess, emphasize is this is really a situation of stored value. The value hasn't gone anywhere. We talked a lot about this in the March and April updates. I'd encourage people to go and have a look at those. And as an aside, the month of May that we had actually is a really good example of what we're talking about here. We had a really strong month. We were up 6% on the month. And the biggest driver of that was us unlocking value from a really portfolio that's massively pregnant with value at the moment, with a lot of catalysts in place. May was a really good example of the kind of things that we're able to do at the moment.
Absolutely, I completely understand. And just to reiterate, when you talk about a much higher return target, you are actually specifically referring to the discount capture strategy part of our strategy, as opposed to buying something cheap and hoping that it goes up.
Exactly. So we're separating what I'm talking about here from what markets have done.
Right.
So markets have had a wonderful bounce back.
Right. Okay.
We all emotionally hope they keep going up. They might not. And they've certainly come a long way. And there's a school of thought in the market that maybe they've gone a bit too far, a bit too fast. But putting all that to the side, what we're excited about is the things we go around the world buying. We're currently able to buy much, much cheaper than we normally do.
Okay.
And over the medium term, like not on a day-to-day basis, but over the medium term, our ability to unlock that value, that's really our core skill set, and it's very independent of what markets are going to do next.
Okay, well, perhaps you can elaborate a little bit more on this point, Miles. Why is the investing universe so exciting, and where are you finding the opportunities?
Sure. Well, I guess the first thing to understand is when you have these big periods of stress, like we've just had in March of this year or back to October of 2008, as I was saying, discounts and everything move around wildly for a period of time. And what's happening then, and what's driving all this is liquidity, or rather lack of liquidity. Panic starts to dominate the market, all the buyers step out of the screen, and very small amounts of distressed selling can move prices around quite irrationally for a short period of time. We're going to see that on this chart that we're putting up here. And what this chart shows is it's the UK and the US closed-end fund sectors and the average discounts for these sectors over the last 20 years. You can see that in March, discounts spiked out to the extreme levels they reached in the financial crisis. And it's important to say these sorts of discounts, these levels of discounts are not sustainable for any real length of time. The arbitrages they present to specifically to firms like ourselves are just too great. But in the short period of time, for short windows, they can and do exist. And what's driving them is fear and, as I was saying, a lack of liquidity. We took advantage of this spike down in March as best we could. But in reality, there wasn't actually a lot of stock trading in the market. We were trying to get stock. We certainly put some money to work. But the reality is this big spike down in discount is a bit misleading. There wasn't much volume actually transacting in the market. Since March, fear has subsided, money has returned to the markets, the liquidity issue has started to dissipate, and we've seen a big bounce back in average discount levels. And I'm going to come back to that concept in a minute, because average discount levels is something that people spend a lot of time looking at, but for our specialist strategy isn't actually that meaningful or helpful. But I'll chat about that in a moment. If we ignore the March spike down, what's interesting to us now is that discounts have settled down again. There is volume trading in the market. We're able to get in and out of the names we normally trade without too much difficulty. But it's settled down right at the bottom of the longer term ranges that we see in these two big markets. Over the very long term, ignoring the two spikes I was referring to, discounts in the US and the UK, the two biggest markets in the world, have typically ranged between 2 and 10%. And what the first clue as to why things are exciting for us right now is that we've settled right back down at the bottom of that longer term range, a 10% discount.
Wow, this slide is actually really interesting, and those moves dramatic. Before you do move on to the next slide, Miles, I just wanted to make an observation, if you don't mind. What strikes me about this graph in particular is the fact that for most of GVF's life, so from May 2014 onwards, we've operated our strategy over a time when discounts have been much tighter than they are today.
It's been a much tighter environment, definitely.
Yeah. And in that same environment, we've still managed to generate an annualized discount capture return of 6%.
So that's 6% of return above and beyond the market.
Absolutely.
Yeah.
Wow, yeah, absolutely. So again, looking at the graph on the screen, I guess you're making the natural observation here. So to go back to my point earlier, that you expect return targets to be higher because discounts are so much wider.
That's it, exactly. In a nutshell, absolutely.
Okay.
But maybe to refine that a little bit, I'm going to show this chart here, and possibly what's more interesting to discuss is that this idea of looking at average discounts and how average discounts are behaving doesn't really do justice to the scope of the dislocations that are happening in our universe, or show why the universe is much more exciting for us and our strategy. So this chart shows the more recent history of just the UK closed-end fund sector. And what we can see here is that simple average chart, the simple average line again, the navy line. But we're also showing around that the dispersion around the mean, the range of discount outcomes has expanded really greatly since the March sell-off of this year.
I see that.
And what's got us much more excited is not so much that average discounts have moved from 2 to 10%, but the bottom end of that range has moved from 15 to wider than 30, and hasn't really moved such much since the March low. For us, there's now a really interesting universe of deeply discounted asset plays to be running our ruler over, both for the trading opportunities that we find and exploit in the market, and also the value with catalyst situations that we find. And maybe just to finish off on this point, I know you and I have talked to investors about it quite a bit in the past, but one of the big advantages we will always say that we have in the market is this stated desire to stay relatively small. We want to be small, light on our feet, nimble, and by being relatively nimble, we're able to exploit some of the more interesting situations we find around the world. That wouldn't be the case if we were trying to run billions of dollars in the market. And in truth, one of the reasons we're finding interesting things, still finding lots of interesting things to do at the moment, even though markets have bounced back a long way, and as you've just seen before, even though average discount levels have come in a long way, is that this bottom right-hand corner of the chart, which is a bit really that's gotten us all excited, is quite a small part of the overall universe. It's quite big for us and what we're trying to do, but in the scheme of things, it's a smaller part of a much bigger universe.
Okay, so this is obviously an impossible question to answer, but I'm your wife, so I'm going to ask it anyway. How long do you think that this current environment is likely to last for us at GVF?
Tough.
That's me. Tough questions.
The team and I invested in the strategy through 2008. And having seen, how we're coming out of the March correction here and remembering how 2008 played out, I think the 2008 playbook is probably the best guide we have to go through. And what happened in 2008 was you had the big correction and then a big snapback. And like I was showing you before with average discount levels, that headline average figure that people spend probably a bit too much time looking at, that headline average figure came up quite quickly. But that wasn't the case for still quite a meaningful universe of names that were less liquid, that had more complicated underlying stories where you had to really roll your sleeves up and understand the assets. Or finally, also an important universe, names that had big discount problems before the crisis. They typically blow out to a new level and stay at that new level. They don't normalize. So for us, having invested through 2008 and followed the strategy ever since, even after the big snapback in 2009, even after markets had come back a long way and average discount levels had come in a long way, we were still finding some really interesting places to put money to work at levels that much wider than we normally find in the less obvious parts of the market. Some of them required more work on our behalf and perhaps more activism, but we were still putting money to work for a good year or two after 2008 at levels much wider than we would normally find. So that certainly seems to be how things have begun to progress from here. The larger, more liquid names have normalized relatively quickly. We're still finding lots of really interesting things to do in the less obvious parts of the market, and my hope would be we've got a good year or so left of unusual opportunities for us. Of course, we what we do in normal times are very excited about. What we're trying to say at the moment, things are extra interesting.
Okay, well, I'm very excited. Looking forward to that.
Yes, hopefully. And now maybe I'll ask you a few questions. I know you spend a lot of your time engaging with shareholders, even in good times. The last few months, it's been in overdrive, and you've spent a lot of time on the phone and on emails asking and talking to shareholders. Are there any particular themes that are coming out, or any questions it'd be helpful to share with everyone today? Sure.
I mean, the first thing that springs to mind is dividends. Dividends are front and center of so many investors' minds. And it's hardly surprising when we're seeing headlines constantly of, Australia kind of leading the charge on dividend cuts. Our investors have therefore been looking for some comfort regarding GVF's dividend policy. Now, it's worth saying that formal dividend decisions sit with the GVF board, and I cannot speak for them. But what I can say is that GVF has continued to build up a really healthy profits reserve over the years. And at the end of May, after we paid out our last dividend, our profit reserve was sitting at 7.9 cents per share. So while our current dividend payout rate is 5.8 cents per share, that means that we have, just under a year and a half's worth of dividends set aside in our profit reserve. And in addition to that, we've obviously now started the new financial year, and with that comes the ability to add to the profits reserve again. Nobody can predict the future with certainty, of course, but listening to you talk today has given me some cautious optimism, I guess.
Hopefully we'll be adding to it this year.
Absolutely, absolutely. So that's a good thing. And again, just saying, I think it's fair to say that we've come into this period with a strong buffer in place in terms of our current dividend payout rate. The only thing I'd finish off with is just a word on the franking. And so just to mention that, we can't store up the franking credits in the same way that we build up our profit reserve. That means that we don't have the same sort of buffer with our franking credits as we might do with our ability to pay dividends. So perhaps a little less certainty on how fully franked our dividends might be over the coming months.
Okay, so dividends, always an important topic now, so I guess there's extra focus on it. Any other issues or things that are coming up?
Yeah, for sure. Absolutely. I mean, obviously talking about the severe market downturn that we've just experienced, the volatility that introduced, clients wanting to talk about that. But I think you've done a really good job of that today, especially with those two graphs. So you've probably covered that. I guess then the last point I'd bring up, and that shareholders do bring up with us, is that of shareholder communications. And how we're going to communicate with them in the future going forward. And I think, hopefully you might have noticed that we've recently upgraded our email system, moving Miles and I into the 21st century, I hope.
Kicking and screaming.
Kicking and screaming, exactly. We've also recently updated the website with all the distributions that GVF has made through time. So that's available in both a graphical and a tabular format. We've got this video today that we're doing with questions and answers and kind of just talking through the markets. A lot of investors have commented that the voice memos that you and I send to them on email is something.
It's actually an interesting thing. So we get a lot of emails in, and we encourage everyone to send emails in. Please, there's no question that's too silly or that you should be shy about. But we find that we can answer them quite quickly and with a lot more colour.
Yes.
If we leave a little voice memo. So we spend a lot of our time leaving voice memo for shareholders that we just email back to.
It's like the new voice. It's like the new voice.
Exactly.
Yeah. Exactly.
So that's had really good reception.
That has, yeah. So that works quite well. And then, obviously we write those articles for First Things. Those are very popular. And then in addition to that, we've been asked for some additional shareholder reporting. So just performance reporting, hopefully putting some of that onto our website and onto the monthly. Yeah. Exactly. And hopefully you would have noticed that with this video, we've sent out a survey. It's a 1 to 2 minute survey, just asking for your opinion. What would make most sense for you? What do you enjoy receiving from us? And what would be a priority?
This is your company. Tell us what you want us to do, and we'll run off and do it.
Exactly.
And I guess that's probably a wrap, right?
Absolutely.
If you've got time, the survey would really help us trying to understand what things we can be doing better. And if this video is helpful, there's certainly the kind of thing we could continue to do in the future. So
perfect.
Cool.
Well, thank you so much for joining us. Please keep safe and keep well.
Thanks, everyone.